I want to shift back over to the markets, though, because we are seeing a bit of a sell-off today, muted with all three major indices in the red now. Last week, our next guests had been flagging this Dow theory buy signal. Last week, of course, when that happens, you see the industrial average or the transportation average making new all-time highs. And for more on that, let's bring on the guest here for what that could have signaled, because even though we're down today, we got an up week to celebrate. Jeff Saut is Capital Wealth Planning Chief Market Strategist, and he joins us now. Jeff, appreciate you coming on here to chat, man. I mean, the end of the week has been, I guess, maybe capped by some strength here in those big tech names we've seen kind of trade sideways for a while. Facebook's still in the green to wrap up the week. What's your take on where we're at now and where the market goes from here?
Well, in the book Reminiscence of a Stock Operator, there was a character called Mr. Partridge, and they called him Old Turkey because turkeys were very smart, and he was a very shrewd stock market operator. And people would come up to Old Turkey and ask him what they should do in the stock market, and he would tilt his head to one side, and with a wily smile, he would say, "It's a bull market, you know." And that's what we're in. We're in a secular bull market. We've been in a secular bull market since March of '09. Secular bull markets tend to last 15 to 20 years. So we're like 11 years into this one. We ought to have at least another 4 to 8 years left in this, and nobody believes it.
Yeah, I mean, there are people who believe it. I suppose the question, and now we keep hearing from a lot of their market guests, is when this pullback's going to be coming, and what's going to trigger that. Some people had thought maybe perhaps it would have been the wins in Georgia for the Democrats. That didn't pan out. It could have been some of the controversy around the election here and the inauguration. That didn't necessarily pan out either. You have a year-end target on the S&P for 4,100 here, which would seem to indicate some upside. I don't assume it's going to be a smooth right line, though, here. So maybe what are some of the risks out there you're watching right now?
Well, January is always a tough month, especially in the back half of the month. And you've got the virus that people need to worry about. You've got a new administration. You don't know what's going to come out of that. I lived in D.C., and I've never seen in D.C. such disarray that it's in right now, and that's an issue. Nevertheless, the market is forward-looking, and based on my estimate of $178 for the S&P this year, I think a 23 multiple is the right multiple for the current interest rate environment. Yields a price target of 2,100, and markets always tend to overshoot. So I would say 4,100 to 4,200 on the S&P is a decent target price for this year.
I'm glad you mentioned earnings, though, because obviously we're going to keep getting those updates rolling in through here. A few ones to point to, including Intel. That might be more of a stock-specific focus, but we saw from the banks, a lot of these expectations were topped kind of across the board, but interesting to see a lot of these shares trade lower after those beats. What do you make of maybe how earnings season's shaping up here and expectations, particularly how topping expectations might not be enough to see shares pop?
Well, I think earnings are going to continue to come in better than expected. I continue to like energy and financials. Those have been two of the out of favor groups. Financials have actually come back into favor recently, but they're cheap. Both energy and financials are cheap. And my daddy used to tell me good things tend to happen to cheap stocks.
Yeah, that has been some of the expectations here, particularly in the energy sector. And we've seen oil prices fluctuate, and they were getting close to what was the upper bound from one of our closely watched energy experts, and Stephen Shork, saying $55 on crude seemed to be the highest expectations you'd see here. What do you make of that, and particularly how a weaker dollar may have driven that rise? How do you see supply and demand playing out in the back half of 2021?
Well, energy pulled off a little bit here recently, and that's because people are worried about a drop in demand out of China, Russia, et al. I don't buy it. I think we're in a synchronized global recovery. I think in the back half of this year, the economics are going to get stronger, not just here in the U.S., but around the world. And I think demand for crude oil is going to go up. So I like the energy sector. They have decent yields. The stocks are cheap. And I have been buying energy stocks as well as banks.
Yeah, when we talk about where we go from here, obviously before we were just chatting with Rick Newman about those potential expectations around the $1.9 trillion package. Some people saying that might be a little bit too big in terms of what the market needs right now. But when you factor in, another 900,000 unemployment claims we got yesterday, What do you make of maybe where the market expectations are for what we could what we could see come through here as Biden really does want to go big as he starts his administration?
Well, I think the expectations in the market have come in lower than the 1.9 trillion budget from Biden. I don't know if he's going to get it or not. I mean, I get mixed results from my people in D.C. It's disarray in D.C. right now. As I said earlier, I've never seen anything like it in 50 years of living and working in Washington, D.C. It's bizarre.
Yeah, disarray, I think, is a fair word, but hopefully a little bit more of a return to normal from the early days that we've seen here. Jeff Saut, Capital Wealth Planning Chief Market Strategist, appreciate you coming on here with us today. Have a great weekend, man.
You bet. Thanks.